Hey, good evening, everyone. Welcome, welcome, welcome. So glad you guys could be here with us. My name is Corey Armstead, and I run a brokerage firm called Greater Vision. And my wife and I have been running this firm for quite some time now. And the purpose of, well, the reason why we decided to do that is because we felt there's a greater vision for our community, and what we need to be doing for our money is vital that we all know. It's vital that we all understand what it takes to truly create financial change in our community. I know you guys have been watching the news, and you know everything that's been going on in the world really over the past 8 years, 8 to 10 years actually. What's really been going on in our community in regards to Black Lives Matter, in regards to all the financial crises that have been going on. Being aware of those things and making sure that we all understand and know more about our money so that we can be truly financially independent. And so in 2007, actually, my father retired from Bell South. And so he had worked there for 30 or so years and worked extremely hard, had a nice pension plan that he had, and had some money set aside in his 401k. Unfortunately, 2008 happened, and in 2008, he lost about 35% of his retirement funds. And so at that point in time, what happened was the guy who was managing his money, because my dad didn't know enough about his money to do anything, the guy who was managing his money told him, hey, just listen to me. Take my word for it. I want you to understand. Just leave it all to me. So what happened was the guy actually took his money out of the stock market, put his money all into bonds, and essentially over the next 7 years, his money still has not recovered to where it should be. And so back in 2007, I made it a point, or back in 2008, actually, I made it a point that I would know more about my money than my father ever knew. I made it a point that everyone around me would know more about their money than I ever knew. So I set out on this journey to create something that would enhance our society, would enhance our people, and make sure that we all know more about what we're doing with our money than anyone else. So if you learn nothing else today, there's a couple of things, a couple of points that I want you to take down. Actually, the first thing I want you to do is write down a question. What does financial independence truly mean to you? Okay, what does financial independence mean? Number two, what will it take for you to retire? Meaning financially, what will it take for you to retire? Okay, so pick a number. Say, hey, I want to have X, Y, or Z amount of money in order for me to retire. Okay. Next point I want you to think about is this: how long is it going to be before I can actually retire? Or what age do I want that to be? Okay? What age do I want to be when I retire? Okay, so if you're in retirement right now, ask the question, well, what do I want the second half of my retirement to actually look like? Okay, so those are some questions I want you guys to think about. The last point here is I want to challenge you. I want to challenge you in a significant way here tonight. I want you to think about, what does it take to become wealthy? Okay, so I'm going to give you some 3 points which we feel are tried and true. They've been tested. But I want you to also think to yourself and say, well, is what he's telling me tonight truly what it takes to become wealthy? Okay. Will this create financial independence or not? Or do I know a better way? And if I know a better way, then I would love, love, love for you guys to call me and tell me after the call and let me know your better way to become financially independent. Okay. So what I want you to write down on your piece of paper right now is 3 things. Right? We call these the 3 principles of wealth. 3 principles of wealth. Okay. So principle number 1, you have to be able to save as much money as you can, as fast as you can. Okay. So that's principle number 1. These are the 3 principles of wealth. So principle number 1, you have to be able to save as much money as you can, as fast as you can. Principle number 2, you have to be able to get out of debt as fast as you can. Okay. So principle number 1, save as much money as you can, as fast as you can. Principle number 2, get out of debt as fast as you can. And principle number 3, you have to be able to protect the wealth that you have yet to create. Okay. Protect the wealth that you have yet to create. So this is the framework which I want you guys to think through the whole entire 30 minutes that I'll have you guys here tonight. I want you to think through and have these 3 things in your framework, because it takes not 1, not 2, but all 3 of these things to create true wealth. Okay, not to make great income. Okay, there's a lot of ways to make income. Not in order for you to have to become rich. Okay, because there's a lot of ways to become rich. You can win the lottery tomorrow. But to create true wealth, we believe that these are the three things that are essential to that happening. Okay, so let's go ahead and go through the presentation here. And I want to go through a few things, a few slides, not many, just a few. But ultimately, what we want to talk about tonight is how money actually works. Okay, how money works. Because what we know is that everyone is concerned about money issues. Right? We're all concerned about money. You're probably thinking this morning, how can I get that extra raise at my job? How can I, maybe I can pick up an extra shift. Maybe I can do some real estate. Maybe I can go gamble, whatever it takes. What is it going to take for me to make a few extra dollars? Everyone wants to know what it takes to create more money. But if we truly understood how money works, we would know that making more money is not necessarily the key. Okay? What the true key is that you need to become an owner of your money and not a loaner. Okay? So what do I mean by that? What does becoming an owner of my money and not a loaner mean? Well, ultimately what it means is this. Take a look at that green circle over to your right. Okay, so this green circle represents the hard-earned money that you've been working hard for. Okay, so maybe you're working a 9 to 5. Maybe you're working several extra shifts on top of that. Maybe you're doing a little bit of real estate. You're doing a little bit of investing. Maybe you're doing whatever it takes to make a few extra dollars. You're doing those things. But then you take your money, or most of us in society, we take our money and put it into this red circle. So this red circle represents traditional financial institutions. Okay, so that means your banks, your credit unions, maybe even CDs. So we put our money into this red circle, which is our traditional financial institutions. And I want to make a point right here because I'm not beating up on banks. There are reasons why we need banks. Okay, we need to have checking accounts, we need to have savings accounts, we need to have our emergency funds put somewhere. But if we're really serious about creating wealth, we cannot do that in traditional banks. And I don't care if it's a black-owned bank, that's been the big push recently in the Atlanta area, or if it's a white-owned bank, it doesn't matter, right? Because ultimately, they're not going to allow you to make the money that you really need in order to become wealthy. Because ultimately what happens is they take your money out of this traditional financial institution, your bank, and they immediately invest it over here into the global economy. So they take your money out and they invest it. So if you thought that they were just keeping your money there in a cubby hole for you till you come back, that's not true because they actually want to make money off of your money. So you have to understand that in order for us to create wealth, we cannot leave our money in banks, okay? Because of this, which is called the banker's rule. So bankers understand this. Unfortunately, us as a society, we generally don't. You may have heard this rule before. It's called the rule of 72. It was coined by Albert Einstein. It's a rule of compounded interest, okay? So the rule of 72 simply states this. If I take the number 72 and divide it by whatever my interest rate is, okay, that'll tell me the number of years it takes for my money to double. Okay, so let me give you an example. Let's say that you had an investment, or let's say, oh, here's another one. Let's say you had a universal life policy, or you had an annuity, or you had something that was going to give you 4% return on your money. Okay, if I take the number 4 and divide that into the number 72, okay, not the percentage sign, just the number 4 and divide into 72, that'll give me 18. That means it takes 18 years for $1 to become $2, or $10 to become $20, or $1,000 to become $2,000. It takes 18 years for that to happen, okay? Let's take the second example here. If I were invested somewhere where I was earning maybe, let's say 6%, okay? So nowhere right now is going to give you 6%. Maybe if you invested in the S&P 500, traditionally over the past 90 or so years, the S&P 500 has done anywhere from 6 to 8%. So even if you said, I'm just going to put my money in the S&P 500, and you were able to earn 6% a year. Well, let's take the number 6, divide it into the number 72, and I'll tell you that's going to take 12 years for that money to double. Okay, 12 years for that $1,000 that you have there to become $2,000. All right. Well, let's take a look at 12%. And so why I chose the number 12% is because that is what our firm has traditionally, we have done that since the Great Depression, not the Great Recession, the Great Depression. Okay. So the funds that we have been investing in have been averaging 12% since the Great Depression. All right. So if I take the number 12, not the percentage sign, just the number 12, divide that to the number 72, that tells me it takes 6 years for my money to double. Now, we're talking about doubling periods because I don't know how old everyone is on the call tonight, but I would guarantee you that you have more 6-year doubling periods than you have 18-year doubling periods. Or if your money is invested into your local bank or your credit union, you're only making maybe about 1% a year, probably less than that. You're probably making somewhere around 0.8% a year. But let's assume you're making 1%. So let's use the rule of 72. If I take the number 1 and divide it into the number 72, that means it's going to take 72 years for $1 to become $2, okay? And I know you don't have 72 years to wait. So let me give you an example of what this looks like for two separate families. So let's assume that two families had $5,000 to invest, okay? The family on the left invested $5,000 at 4% interest, okay? The family on the right invested that money at 12% interest. So now, at 4% interest, we said if we take 4 and divide that into the number 72, it'll take 18 years for that money to double. So at year 18, 5,000 has doubled to become 10,000. And another 18 years at year 36, 10 has now become $20,000. Okay, so that's what 4% interest looks like. Now, let's take a look at the opposite side and see what happens if we were averaging 12% on our money. So now at year 6, 5 becomes 10. Year 12, 10,000 becomes 20,000. At year 18, 20 becomes 40. At year 24, 40 becomes 80. At year 30, it becomes 160. In the year 36, that now doubles to $320,000. Now, I know the answer to this question, but I have to ask it anyway, so it's kind of rhetorical. Which side of the line would you want to be on? Would you like to be on the left-hand side, making $20,000, or on the right-hand side, making $320,000? And I know what the pushback is going to be. The pushback is going to be, well, the stock market is too risky, and I don't want to risk losing any money. Well, here's the question, or here's an answer to that question, actually. Am I losing money if I invest at 4% or at 12%? Okay, which one am I actually losing money on? So let's take a look at the two sides. At year 36, at 4%, I have $20,000. So someone guaranteed me that I would have 4% interest on my money. So your universal life policy, or maybe that's your annuity, or whatever your money is invested in currently, they guarantee you 4%. On the opposite side, they're going to get the other 8%. So they're going to have 12. So are you really making money if you're actually losing $300,000? Because the bank got the other 300. You didn't get it. So you actually missed out on $300,000 because you settled for a guarantee. So write this down. This is also very important. You can never create wealth in guarantees. It is impossible. Okay? A guarantee is a contract. A contract is never written for you. It's always written for the person who wrote the contract. So they will get the better side of the deal. In this example, the bank guaranteed you 4. They made 12. They gave you 20,000. They made 320,000. Okay? So now while we're looking at this, the next thing I want you to think about is living off of the interest of your money, because wealthy people live off of the interest of their money. Okay? So living off the interest of your money simply means this. If I were to take that left side of the column at 4% interest and live off of $20,000, that means I would live off of $66 per month in retirement, which the cost of medicine goes up in retirement. The cost of your bills goes up in retirement. Inflation, well, I don't want to even mention that, but all these things will increase in retirement, meaning $66 won't really get you anywhere. On the opposite side, though, if I lived off of the interest, if I lived off of 12% of $320,000, then I would have $3,200 per month to live off of. Again, which one would you prefer to have? Okay, so let me give you an example here of what this looks like actually generationally speaking. So we're talking about investing our money and creating wealth generationally, because that's what we believe in as a firm. We believe that it's not just about me or you, it's about our kids and our grandkids and our great-grandkids. So let me give you an example of what this really looks like. Okay, so let's assume that you were comfortable living off of $50,000 in retirement. Okay, $50,000 per year in retirement. When I say retirement, I don't mean you don't work anymore. What I do mean is that you have the option of never working again. So that's what independence means for us. You have the option now to never have to work again, meaning how much money do I have set aside that I never have to return to work? That's retirement for us. So let's assume you want to live off of $50,000 per year in retirement. Well, we teach a principle that I need to be able to live off of 10% of whatever money I have saved up, because that creates freedom. so that the principal is never touched and that I can live off of this amount of money every single year in retirement. So when you think about this number that I'm about to write down here is called your financial independence number. Okay, so that is this number that's $500,000. Because what I did is I took $50,000 and multiplied it times 10, which will allow me to live off of 10% interest, live off of 10% of that money every single year for the rest of my life. So to get your financial independence number, which we call your FIN, okay, you need to take whatever you want to live off of in retirement, multiply it times 10 to get that number. So in this example, that's $500,000. Well, how do I get to $500,000? Two things that you need to think about. One, what is your interest rate? Okay, so what are you making? So let's say we're averaging 12% like we talked about. And what time period that needs to happen. So let's assume you had 20 years to make this happen. Okay. What do I need to be putting away every single month for the next 20 years so I can have $500,000 at 12% interest? Well, I need to be putting away about $500 per month. Okay. $500 per month at 12% interest over the next 20 years will give me $500,000. So that I can live off of 10% of that money, living off of less than what I'm making. I'm making 12. I'm living off of 10 so that my principal is never touched. Okay. Now, what does this look like generationally? Well, I have a little girl. So when my wife and I pass away, okay, I have a little girl. Her name is Naya. She's 18 months old. So what I'm going to teach her is the same principles I'm teaching everybody on the call tonight, to live off of the interest of your money. So what I want her to do is allow the money to sit for 2 doubling periods. Okay. So therefore, at year 6, this $500,000 now has become $1 million. Okay. In year 12, this has now become $2 million. Okay. Now I'm going to tell her to go ahead and live off of the interest of that money. Okay. So now she can live off of $200,000 per year, right? 10% of a $2 million is $200,000 per year. Okay. Now, what happens when Naya passes away? Well, hopefully she has a child. So this would be 3rd generation Armstead. Okay. Our 3rd generation, our grandson, granddaughter, whatever that is. I'm going to teach the same principle. Okay. Because this is what wealthy people do. They create generational wealth. So they teach these things. These things just get passed down from generation to generation. So now year 6, that 2 million now has doubled and becomes 4 million. Okay. At year 12, that 4 million has now doubled and becomes 8 million. Okay. Now my little girl or my grandson can live off of 10% of that money, meaning $800,000 per year. Okay. $800,000 per year as just throw around money. Okay. Just money that comes into their household every single year, no matter what happens, because they're living off of less than what they're making. They're making 10%. They're living off of 10. Their money's making 12. They can live off this money forever. Okay. This 8 million never goes anywhere. It just gets passed down from generation to generation to generation. So ultimately what you have to understand is that in order for us to create wealth, it has to start somewhere. We have to start by being dedicated to making a commitment and putting away a certain amount of money every single month for the next 20 years or the next 30 years or whatever that game plan looks like for you. Okay. So that's what that looks like generationally. Now, that's part number 1. Part number 1 we talked about, or principle number 1 is saving as much money as you can as fast as you can. Principle number 2 is we got to get you out of debt. Okay. So while I'm helping you save, while I'm helping you invest, while I'm helping you do all those things, we also got to get you out of debt. And I got to get you out of debt quickly. Our goal is to have all of our clients out of debt in 3 to 5 years. And so why that is important is because we need our money to double. We need our money to grow quickly. So in order for that to happen, I have to do a couple of things. Number 1, I have to impress upon you the need to not create new debt. Okay, so that's part number 1, no new debt. So don't go buy that new house, that new car, all those things that you may want. Don't finance anything else. Don't do that. Okay, we have to start somewhere. Second part is I got to teach you a simple strategy that's called debt stacking. Okay, it was also famously known as debt snowball by Dave Ramsey, but it's the same principle called debt stacking. Okay, that just tells you who you're going to need to pay, how much you're going to pay, and what order they need to be paid in so that we can get those debts knocked off a lot faster. Okay. And so whoever invited you on the call tonight, they can talk to you. They can give you some strategies on how to get out of debt. But ultimately, we got to get you out of debt quickly in the next 3 to 5 years. Okay. So that's principle number 2. Got to get you out of debt quickly. Principle number 3, which I think is also a highly important principle or a highly important part of creating a sound financial game plan. So what we're talking about here is how do we create wealth in a sound financial game plan? Well, the third principle we talked about is protecting your income. So if I were to die today or tomorrow or tonight, how would my income be protected for my family? So how would I be able to leave something behind if I have not created that financial independence number that we already talked about? How do I do that? What does that all look like? Like, how does that work if I don't have all the money saved up? The answer can't be I own a bunch of houses and therefore they can sell them off. Okay, that can't be the answer because you saw what happened back in 2008 when the housing market crashed. And it's just now really started to recover, at least in Atlanta. I don't know where you live, but at least in the Atlanta area, it has just now really started to recover. So therefore, what would happen? Well, I'll try to sell that house off, and I won't be able to get the value that the value that the house is actually really worth. So that puts me in a predicament. That puts my family in a predicament. If I were to die, and they say, "Hey, just go sell off some of those houses that I own," and the houses aren't worth half of what you thought they were going to be worth. Okay, so we need to be more sound with our income protection. Also, it's called life insurance. Okay, so making sure that we're leaving something behind to our families so that their financial future is secured. Unfortunately, in our community, 9 out of 10 African Americans do not have their own individual life insurance policy. Okay, and it's about 60% of all other races do not have their own individual life insurance policy. Okay, and so I stress that upon you because I don't want us to rely on our jobs to get that done for us. Okay, I want it to be upon us. And so this theory that I have on the screen here is called a theory of decreasing responsibility. And so what that really means for us is this. In the early years, when you have children, you have high debt, you have high mortgages, okay? You have a lot of things that need to be cared for. You actually need a lot more insurance at that point in time. As time goes by and you pay off the house, the kids are grown, they're out of college, you lowered your debt some, you actually need less insurance at that point in time. So go figure. Insurance companies want you to believe that you need to actually have insurance for your whole entire life, which is called whole life insurance. They assume that you need to have that. But what company is actually going to tell you that you actually don't need it for your whole entire life? Who's going to actually tell you that? Well, we're telling you that because we want you to actually be financially independent, okay? And so what I want to show you here is something that we talk about in having your money and your having your investments and your insurance tied up into the same policy, okay? It's also called whole life, also called universal life, adjustable life. There are a lot of different names for it, but they all mean the same thing, cash value, okay? So what some people will make you or will allow you to believe is that you should have your money, your investments, and your insurance tied up in the same thing. Well, here's the reason why you shouldn't have it, okay? Number one, you can't start making money. You can't start earning interest on that money for about 3 to 5 years in a universal life or a whole life policy. Okay, you have to wait 3 to 5 years for that money to actually start making interest or that money to start growing. Whereas if I have a separate investment account, I have my insurance in one place and my investment account in a separate type of deal here, that allow you to earn interest from day one. Okay. The second point I want you to know is that after a waiting period, okay, so that waiting period we just talked about, you're guaranteed possibly to have about 4% interest on your money, okay? So your money will grow at a rate of 4%. We already talked about why that's not the deal. You don't want to be earning 4% on your money. You actually want to be earning 10 to 12%, but you can't do that if it's tied up into an insurance policy, okay? The next point I want you to think about is this. They talk about you have the ability to borrow against your money. Okay, so you want to borrow. Well, why would you want to borrow when you have to pay 8% interest on the money that you borrow? So why would you ever do that? When if you had your money in your investments, you don't have to borrow it and it's yours. You can take your money out whenever you want to. You get your money back in about 7 days or so, and you don't have to worry about borrowing any money and paying it back. Okay, so we recommend you actually have something that's called term insurance. Okay, so I'm going to show you another comparison here between term and cash value, but we actually prefer that you have term. As a matter of fact, that's what we believe is the most economical way to make sure that your family is financially secure. Okay, so here's an example. John and Mary, $75,000 apiece, so a total of $150,000, and they're paying about $114 per month. Okay, whereas if we took them and said, look, let's actually get you into a term policy, 30-year term policy, where you get $250,000 a piece for a total of $500,000 worth of coverage, and you pay $66. So they actually end up saving $48 per month. Okay. Now, what did I tell John and Mary to do with that money? Well, I told them, go ahead and take that $48 and invest it. Okay. Take that money and put it into your Roth IRA. Okay. Into your brokerage account. So what happened with John and Mary over the same length of time that they had that 30-year insurance policy? Okay. They invested that $48 and they end up having basically $170,000 at the end of that 30 years. Now, that 170 was worth more than they actually would have had in that whole life policy anyway. The whole life policy was only worth $150,000 for them. So they actually have more money set aside that they can access, that they don't have to borrow from in a shorter time period. Okay? 30 years as opposed to having full access to that whole $150,000 in that policy at the age of 100. Okay? So next point I want to show you is something real quick, that how we determine what type of coverage you need, or how much coverage you need. It's a simple acronym that's called DIME. Okay? And I want you guys to write this down in the middle of your page there if you're taking notes, DIME. So what DIME stands for is death, income, mortgage, education, and debt. Okay? 5 things I want you to think about when you look at your policy and make sure that you have enough coverage. Death is how much a proper burial costs, which is about $10,000. We'll skip down to the mortgage. How much do you owe on your house, or if you're about to own a home soon, how much do you want to pay for that house? So let's say that's $200,000. Okay? And for debt, how much do you owe money on? So let's say that you owe $40,000, whether that's credit cards or student loans or lines of credit, whatever that is. Okay, you add up all these numbers, and if you had a spouse, you write on the opposite side for the spouse. Okay, same thing on the opposite side for the spouse. You add all these numbers up, and that tells you how much coverage you actually need. Now, if you wanted to pay for your child's education, you would pay for that there. Okay, you would add that into your policy as well, because if you don't have all that money saved up in that 529 that you have, then you want to make sure that you can leave that money behind to them in some way, shape, or form. Income. How much money do I want to make sure that my spouse has if I pass away? I want to make sure that she has at least a year's worth of income or 2 years worth of income. Whatever that number is for you, you could add that into your policy as well. Make sure you have enough coverage. Okay? So those are the important points that you need to think about when it comes to the third principle of wealth, which we talked about is called protecting income. So this is all about how am I protecting my income and making sure that I'm not leaving behind debt, but instead I'm leaving behind wealth. Okay? So at some point in time, what we don't know will cost us, okay? And I don't want it to cost anyone who's on the call tonight. As a matter of fact, I want you to be prosperous. I want all of us to be prosperous. And so at the beginning of the call, I challenged you, and I said, let me know if you know of a better way to actually create wealth, not create income, okay? So that's different. Not create riches and money, because we assume that just because we have that extra job or that extra money, that's somehow going to create financial independence for us, which it won't, okay? However, I want you guys to think about what it takes to be wealthy. So hopefully I went through those points with you tonight and that made sense to you. If it didn't, give me a call or give whoever invited you on a call the opportunity to explain that a little more, okay? But ultimately, what I want you guys to think about is this. We as a firm are looking for people who want to know more about their money, okay? We want clients that want to be educated about their money. And we're also looking for people to help us out with the mission, because we have a great mission, all right? Our mission is what we call the $1 billion movement, all right? It's called the $1 billion movement for us. So the $1 billion movement for us means we want to make sure that we are creating the next generation of wealth. And how we're going to do that is this. We're going to have $1 billion of money invested by Black investors, meaning I'll need other people who want to get their investment licenses. Okay, we'll pay for you to get it. We just want you to have that desire to help our community out and help them with investments. Okay, that's number one. Number two, we want to make sure that we're leaving behind $1 billion of money to the next generation. Okay, so we're going to do that through the form of life insurance as well. So we want to have people who want to help us out with that part of the mission, maybe even get licensed in the area of insurance as well. Okay, so we're looking for people who want to get more information, who want to get educated, who wouldn't mind sitting in a class, who wouldn't mind it if I told you right now that I would pay for you to get licensed, I would pay for all of your study materials, I would pay for all those things for you, as long as you were dedicated to the mission, you were dedicated to improving your family, you were dedicated to learning more about your money so that no one can pull the wool over your eyes and tell you, hey, this is what you should invest in, this is what you should do with your insurance, this is what you should do. If you care enough about yourself and care enough about your family and care enough about your community that you want to learn more, then just let us know. Okay, because we can get you into a class, we can help coach you, we can help train you on your money. Or if you know other people who may be interested in learning more about money, then just let us know as well. Okay, we wouldn't want you to work for free. No, we wouldn't do that. We would obviously make sure that you're compensated, and the person who invited you on the call can tell you more about how compensation works. But ultimately, what we want to do is create a new generation for our community. Okay, we want to make sure that we're creating financial independence, that we're not creating people being dependent on their jobs or being dependent on the government or anything else, that we can create a new generation of wealth, okay? So thank everyone for being on the call. It's 8:30. I promise you I'll have you off at 8:30, so it's 8:30 right now. I thank you so much for being on the call tonight. And again, if there's any way that we can help you as a firm, if you want to learn more about what we do, just give us a call, let us know, and we would love to help you. Thank you and have a phenomenal, phenomenal night.